Hey everyone, today we're going to talk about non-qualified deferred compensation plans. We're going to talk about what they are, how they can be used, and some of the things you need to worry about. Derek Mazzarello with Gateway Financial Partners. All right, let's get into it. First of all, it's just basically another company retirement plan vehicle. So, for example, the big thing is you're going to get some pre-tax deduction. So, the way it works from a taxation standpoint is you're going to take a pre-tax deduction going in, the money's going to go tax deferred, and we take distributions out, that's when it's taxed. Okay. So pretty straightforward. It's taxed pretty similar to a traditional 401k, traditional IRA, but generally you want to stack this on top of it. I'll get into a little while later, but non-qualified deferred compensation plans should come in after you've already maxed out your 401k. So if you're already maxing that out and looking for another avenue to reduce your taxes, a non-qualified deferred comp plan can make some sense for you. And let's look at a couple ways where it would make sense to use. So let's say you're in a higher income bracket, because typically most people that are going to get non-qualified plan deferred comp plans are going to be key executives at companies or really high income earners. So a lot of this comes down to just simply tax planning. The benefit of these is you get tax deductions now, but if you overdo your tax deductions, you're deferring all these taxes, and you're going to have this huge tax bill later on in retirement, which can come back to backfire and actually cause you to have more taxes in retirement and over the course of your life. So let's say this is your income bracket up here while you're working. Let's say this is your retirement date here. Most people kind of have this dip in retirement if they have other sources of income, and this is where the planning can really come in and be helpful. So make sure you kind of go over this stuff with your accountant as well. And then typically when Social Security and RMDs kick in, their tax rate's going to increase again. So let's say you're here at the 37% bracket now, which is the highest current bracket. Could go up later, who knows? So what it'll let you do is, let's say, take your discount here, so reduce your income, and maybe it only reduces you to the 35% bracket, but every dollar you put in, you're essentially saving 37 cents on today. The hope is that maybe I'm paying 22 or 24 cents on that down the line. And how do we do that? So we take this dip right here and say, okay, maybe from 60 to 70 or 65 to 70, I've got this window where I'm going to maybe increase my payments and have my payments come out from my deferred comp plan here. And like I said, maybe without it, I'm at the 22% bracket, but maybe that even bumps me up to the 24. Hey, you know what? 24 is still lower than 37. That's a nice win there, and it gives us maybe an opportunity to bridge that gap. Another opportunity we have with non-qualified deferred comp plans is you don't have to wait till 60 to take them. So as you declare your date, and as long as it meets the plan rules, you may be a good vehicle to save for college for your kids. So maybe you have, all right, we're going to take this money out for a 5-year span. We're going to pay for college for our 2 kids with overlapping college dates, and we've got this nice chunk of money that we're saving aside for that. So there's definitely a couple rules and a little bit more flexibility that a non-qualified deferred comp plan has compared to a traditional retirement plan. Um, but one of the things you want to look at are what are some of the actual downsides of the plan. So let's look at big X for negative. We don't like this. So one of the big issues is it doesn't follow the ERISA guidelines. So it's not ERISA protected, and it's not creditor protected. So if you ever get sued, it can go after you. The other thing you need to worry about is solvency. So the company's not, if you put $1 in the non-qual plan, the company's not automatically just saving it. Some companies maybe, but they're not required to put another dollar in the fund for you. So one of the challenges here, if the company totally goes under, you can have some issues with your account in general. The other thing is they can be a little restrictive with their distribution schedules. So that could be either benefit or a negative, but most plans will offer, okay, you can take all the distributions in a single year. You can take them over 5 years. You can take them over 10 years. So one of the challenges is if you select 1 year, you can really have a spike. So we go back to our example up here. If you do 1 year, maybe you have a huge spike and you're taxed again at 37%. So, was that really worth it? Who knows? Or maybe it increases your Medicare premium. So it has all these other kind of domino effects down the line. So that's definitely something you want to have a plan for in advance. If you're starting the plan is when are we going to take this out, and making sure you're aligning everything correctly there. The other issue that I ran into with a few clients is they were working this company. It was publicly traded. They were bought out by a private company, and then they basically just canceled the whole non-qualified deferred comp plan, and they sent out distributions to everyone in that 1 year. So even though some people were doing the proper planning and were expecting to take money out over 5 or 10 years, they had to take all that money out in a single year. So they went from having a 5-year distribution to a 1 year. So as you can imagine, many of them were still working, so they had a huge tax bill in that year when they weren't really expecting it. So there's definitely some pitfalls to worry about when it comes to non-qualified deferred comp plans. But they can, like I said, they can be wonderful tools. They give you some extra tax flexibility or extra tax discounts. But you really just want to make sure you're planning around them. So that, in a nutshell, is how non-qualified deferred comp plans work. Feel free to check out some other videos to see if you can learn something else about some retirement topics. Talk to you soon.